I want to plug my book here. Why not? It's still a top seller on Amazon, Along for the Ride, available on Amazon now. Talk a bit about my chapter 7 in that book. If you've read my book, I do a whole chapter on the stock market and how the stock market really works. And I talk a lot about financial planners and these hosts you see on, or guests you see on BNN, and these stock predictors, and how you're best probably in a lot of cases to ignore a lot of this stuff. So case in point, watching BNN here for the last couple of weeks at night, their market call program, which I watch. I'm kind of selective on who the guest is. There are some good ones here that I'll recommend to you guys, but then there's a lot of ones that I don't know where they get these guys from on BNN. You know, it's like that old, what I've talked about many times before. A lot of times these guys that are available for media, they're at the drop of a hat, they're available to do an interview and talk about real estate or stocks. Usually those aren't the best guys to be listening to, because they're basically unpaid media liaisons, I find. Anyone that's got anything going for them is working and making money and is, a top performer, whether it's in the financial industry or in real estate, doesn't have time for that kind of stuff. I can tell you right now. So keep that in mind. But here is a trend that I'm seeing, that I've been noticing here on BNN quite a bit lately, that just totally drives me nuts. BNN, first off, when these experts come on, these so-called, money managers and experts, they'll recommend stocks, but you have to remember, their stock picks or their stock recommendations really aren't worth much unless you look at them in context to who is buying them and what their situation is. In other words, you'll hear people talk about, they'll call in asking about Bell Canada. Well, Bell Canada is a fantastic stock. It's a sleep at night stock. Sure, you're not going to make a whole lot of money on it as far as capital appreciation goes. You might get 1 or 2 or 3% return, pretty steady, but you earn a nice 5.5–6% yield on it. So for someone who's maybe in their 50s or 60s or coming near retirement, Bell Canada can be an excellent stock. Don't worry too much about the price fluctuations. It's a good stay-at-home, what they call orphans and widows stock. But they'll call in, and of course they'll totally blow it off, and I wouldn't be buying Bell Canada, without knowing what the context is, who the person is, what their age is, what is the size of their portfolio. You would have to ask 20 minutes worth of questions to someone before you could recommend a stock to them. I'm not a professional money manager, but I would never recommend a stock to someone, or not to buy a stock or to buy one, without knowing their situation. Because Bell Canada is probably perfect for a guy who's in his 40s, 50s, or 60s and has maybe a nice sized portfolio and wants to generate a nice yield. It might not be so good for a guy who's 20 years old, just starting out in investing. A better play for him might be a Netflix or an Apple or a Visa or a MasterCard, something with a little bit more growth. And it also depends on where you're putting those shares. Are they going into an RRSP, or are they going into a cash account, a taxable cash account? So remember that. You have to have context with these stock picks. But this is something that I've been noticing, and you guys see if you pick this up if you watch BNN or any of these kind of call-in shows here where they give you stock picks. You get these guys, they'll come on and they'll go for their past picks. So they're on the show, they will talk about stocks, take some calls, and then they will go back a year to what their picks were a year ago. And they will pick 3 stocks, and I've seen this especially now with what's going on in the markets. They have been obliterated. They've picked some mining stocks or some oil and gas stuff. And the last guy I saw here last week, I've seen this guy before, and this is the second time I've seen this guy do this. Had 3 picks. They were all down between 45% and 80% for a total loss of something like 65%. Then they go in and show his disclosure on it, and he selected these stocks April 15th, 2019. And then he goes on to say, we got out of this stock in May 10th. He got stop lossed, which he had a stop loss on it. So if it goes down 10 or 20%, they sold out. So just at the right time, they showed the stock for the last year. And yeah, just before it took its free fall, we sold out of that stock. I don't buy it. And I've seen it many, many times now with these guys. You know, they make these big predictions and they brag, you know, to the ceiling when the stock goes up. But when it goes down, when they come back on the show, they always sold out of it. You know, BNN, you know, if you're watching BNN, if someone's watching from BNN, you know, you need to do a whole lot more disclosure on these stock picks. And if someone is going to go on your show and pick a stock, then they should have the, you know, the ability to at least keep those shares for a year. I know things change, but when you're going on there and recommending a stock to someone and then you're selling it 3 or 4 weeks later, I mean, that's dirty pool, let's face it. And you see that over and over again, and I'm noticing that now big time, that when they're all saying that they got out of the stock. Yeah, sure you did. Some might have, some didn't. But it drives me nuts here. Now, some of the guys, I'll give you kind of the two guys that on BNN, if you're going to watch. The two favorite guys I like are Barry Schwartz and David Baskin. They're both from the same firm, not surprisingly. At least with those two guys, they're kind of a buy and hold type guys. They like to buy good value stocks that pay a dividend, strong cash flows, good balance sheets. They're probably the two best guys to watch on BNN. There's another guy on BNN that, you know, I have to laugh at this guy. His name is Healy, I think Ross Healy. This guy, you know, if you look at his picks, he's been down on Visa for years. Don't buy Visa, even though Visa's up 200%. Doesn't particularly like Apple. He's been in cash now. One of his 3 picks for years now has been cash. And of course, you know, he was on about a month ago when the markets were getting slaughtered here. And of course, you know, feeling pretty good about himself, pumping his chest. But what you don't realize is that guy has been in cash for 5 or 6 years. So he has missed out on 100% gain here being in cash. You see that a lot now. These guys are saying, oh, I've been waiting for the correction being in cash. Well, there's a cost to being on the sidelines and being in cash. Kind of reminds me of that comedy back in the 80s. I have no clue. It was a movie where the guy went into business and decided to start a hamburger restaurant. And right across the street was a Macdonald's with their sign, McDonald's over 20 billion served. And his friend came in and goes, it looks like you've let a little business slip by. You know, it's the same thing for people that have been holding cash for 4, 5, 6, 7 years. These guys that have been shorting the market. Yeah, hey, it looks pretty good now, but there's a cost to being in cash that you'll never recoup. You know, the final thing I'll say on Analyst, and I talk about it in my book, and why everyone, if you're saving for retirement, just buy the index. That's your first step. Just buy a low-cost index, S&P 500, the TSX 100, the NASDAQ, the Triple Q. I really like Vanguard Dividend Appreciation Fund, VIG, VIG. These will cost you less than 10 basis points. So 1% is 100 basis points. Some of these are as low as 4 basis points. So they're cheap. No management fees. You know, these indexes, as I pointed out on my book, and a lot of people have started to realize now, most of these money managers on BNN, these so-called experts, and most money managers in general, all of them, you know, 85% of them cannot beat the index every year. 85%. Yet they're charging you 1 or 2 or 2.5% plus all these trading commissions to get in and out. So you're paying them a small fortune to not be able to underperform the index. And of the 15% every year that by some miracle do end up beating the S&P 500 or the NASDAQ, it's by a very, very narrow margin. After you back out all the fees and commissions, they're just barely beating it, if at all. And the final kicker is they might get lucky and beat it 1 year, but they're not going to do it consistently. None of them will. It's the dirty secret of the financial industry. You know, these experts that have you think that, you know, you need me and pay me to get you and trade you in and out of stock, and that's not the case. Buy the S&P 500, buy the VIG, buy the Triple Q, buy the TSX 100. That will do the job for the vast majority of it. And then later on, like I talk about in my book, if you've got an inclination towards this kind of thing and you enjoy it and you want to get a little bit better yield, sure, start buying some individual stock. But buy the right stock, and only if you do your homework on it. The index will do everything most people are going to need. The crazy thing is, the dirty secret is that these money managers, these guys that come on BNN, can't beat the index. You notice how they never disclose it. These guys never have any disclosure other than their picks and what it did in the last year. I'd love BNN to start publishing this stuff before they make their picks. What is your fund? What is your portfolio done compared to the S&P 500? I can tell you the reason they don't reveal this is because they're getting crushed, these guys. They can't beat it. They're just guessing and trading in and out. It's what they call the churn. That's how they make their money. As I say in my book, maybe the financial industry isn't aware of not being able to beat the index. Well, they're aware of it. But at the other hand, they know that is a threat to how they make their money, which is based on commissions and management expense ratios. It's crazy. So again, people need to be aware of this. And I see so many people making mistakes on this and listening to some of these so-called experts. It's the same thing with Vancouver Real Estate. Buy your principal residence. Take advantage of the principal residence exemption. Take advantage of the 2.3% interest rates. You need a roof over your house. The alternative is to rent for the next 30 years. A one bedroom is going to cost you over $1 million that you're going to have nothing back for. There's no comparison, folks. Anyone that tries to tell you renting, you're going to come out ahead renting versus owning, is lying to you straight up. I've often panned that guy that wrote that book years ago, The Wealthy Renter or something he called it. That guy turned out to be a fake. He doesn't even take his own advice. Have someone break down the numbers for you. Because I still get people that think, oh, I'm renting and I'm going to be way better off. You're not. You're lying to yourself. You're not. Have a look at what you're paying for rent. You're getting nothing back for it as opposed to owning long term. There's no comparison. Interest rates would have to get up to 8 or 9%. The other myth to that too is back when interest rates were at 13 or 14%, hey, for a certain guy, a really disciplined guy, it might work. That means that, sure, they could rent a place back when you could rent a one-bedroom apartment in Vancouver for $450 a month. There was a huge spread. Rents now aren't $450 a month. They're $2,200 or $2,300 a month. And interest rates have dropped down to next to nothing. But the only guy back in the 80s that might have worked for is the guy, sure, you could have saved a little bit of money by renting when interest rates were at 14% and you could rent a cheap apartment in Vancouver. But the vast majority, 90%, it's been proven, it's been written about, did not have the discipline to save the difference anyways. They spent the difference on clothes and cars and vacations. Most people just don't have the discipline to pay themselves first on any savings. But now, run the numbers now. I break them down in my book called The Ghost Ship to Wealth. A lot of people, that took me 6 months to write that, to put it into a simple formula about buying your own home, paying down the debt, creating equity two ways, paying down the mortgage and the capital gain on it, and then it's tax-free. It's the only true tax shelter we get. So these are simple things. There are also things that I keep telling you, I'm going to do some more blogs on this, that they should be teaching this stuff in school. This basic financial literacy should be taught starting in grade school. I'm Owen Bigland. As always, thanks for watching. Stay safe. I'll see you next week.